Good morning, ladies and gentlemen, and welcome to the election show. So what I've done here is I've put down all the various outcomes, of which these two are the most likely, of course. Let's go through them and see why the market might get excited by a red wave or a blue wave. The blue wave is the one that really is not priced in any way in the markets, and therefore that's the one to be worried about. So under a red wave, I'm quite happy that equities immediately rally because, let's face it, you have deregulation, you have corporation tax cuts, everything that equities like. It will be an equities over bonds show, big time. Bonds are the ones that really would not like that outcome because there will be very little prospect of any deficit reduction because of the tax cuts. I mean, how can you both cut taxes and reduce the deficit? It's almost impossible. So this is a big time steepener, the red wave. You really have to hide in the lowest duration. But in any case, these are the sectors to buy. XLF, financial should love it, industrials should love it, and transport should love it. I think transport's probably most of all because you're talking about A, tariffs on China, reshoring, nearshoring, everything that is good for transports in the US. So railways, airlines, etc. It's all good for it. Now let's have a look at what is the most likely of scenario, which is one of these two. And really, I don't think the market cares very much which one it is, because the markets do best when there is gridlock. I particularly favor this outcome, the Harris but a split Congress. There will be selling of equities on disappointment, I guess, but it's really the best long-term case for equities because you get the least adverse impact from rising bond yields. Bond yields, the yield curve might still steepen, but it's really not all that bad. The moves are limited, and therefore I would have thought that it has the least adverse impact on multiples in stocks, and therefore the Santa rally can happen. The scenario that's just not priced in is the blue wave. Under a blue wave, you get tax selling because people will be worried that she'll up the capital gains taxes in 2025, and therefore you want to sell in 2024. And that's why I wrote Santa has been shot dead, because why would you buy equities? It just really doesn't make sense. And it's really the only scenario in which you get a bonds over equities scenario for a bit. So once the tax selling is done, and that's going to take a long time, don't get me wrong. I mean, we're not talking about, Wednesday, Thursday. We're talking about months to the end of the year, basically. That is when the new wave can start in equities, but not until then. So this is the only scenario that's outright bearish for equities for the short and medium term. All the others are a question of how far equities go up and when. I think it's all fairly self-explanatory. The ones that I am really not all that sure are the commodities. To me, the blue wave is actually bullish short and long term, including oil, because you won't have the idea that oil production can go up. So XLE should really not be part of your portfolio if the blue wave materializes. In any case, bear this in mind. This is my thinking of how the markets will reprice, and they will reprice very quickly. Either calls or puts will go to zero very, very quickly. On Wednesday, you will see a total repricing in volatility and levels. Now, just one more word here about the blue wave. The only reason why I think the blue wave would be bullish for bonds in the short term is because there will be risk off, and money has to flow somewhere, so it's likely to flow into bonds. Where else is it going to flow? So that is the only reason why I think for the short term it's bullish bonds and they have a quick spike. But it's not bullish longer term for the very reason that I think it's quite likely that she packs the FOMC with people who are very dovish, and the long end won't like that. So whatever happens, I think that eventually the yield curve steepens, because under this scenario, the Fed can remain very easy. But I also think that under this scenario, it's very, very likely that the market quickly concludes that the 2% target does not really exist in practice anymore, that it's really a 2.5% to 3% target. And that's why I think gold will do well. Even if there is an initial dip, I think you want to buy gold, and you also want to buy commodities, because I think real assets will appreciate over time. And if people are actually selling equities, which is the other protection for real assets, then what else are they going to buy? Are they really going to buy bonds if they feel that, you know, the inflation target is being abandoned? No. And there are very few alternative assets. I guess they could buy some tips at over 2% yield, but I definitely think that money will flow into gold and commodities. Well, it was a weird week in bonds. Basically, all yields are up slightly. Not a huge move in anything. But when we consider that FOMC is almost a lock, and I think it's a lock that they cut 25 on Thursday, it's quite strange that 2 years have been going up, and basically now they are, 50 plus basis points higher than they were when the Fed started cutting. But you can see the shape of the curve. I think any move in twos above 426 is unlikely to last. We could get a quick spike on the election result, but I think the twos is the only part of the curve that I would be interested in buying, unless it's a blue wave, in which case you get a very quick move. And let's have a look at the tens. Could they come all the way down to 399 on, flight to safety? Absolutely. But I don't think it lasts. I think the long end is going higher, and I think we are in a steepening environment and continue to be in a steepening environment. What is interesting is that the twos, fives keep on making new lows. This is where I got out, right, and rode this wave from here. Twos, fives are going out, and look at fives, 30s, they're going up. To me, that says that the market is giving up on pricing more cuts than, I don't know, even 4%. So what the market is telling me is that it's going to be a split Congress with, really it's immaterial whether it's Trump or Harris, and that the Fed will not be able to cut as far because the yield curve is going to go steeper, and that's it. There will be no talk of deficit reduction. The bond vigilantes will continue to do their work, and the Fed won't be able to cut very far. That is what the market is telling you, with the fives being priced the way they are. The fact that this butterfly is moving, okay, so this is the butterfly that I keep on telling you about, twos, fives, tens. This is telling you that it's a split Congress, and really it's immaterial who is president. Twos, fives, tens, butterfly going south. So that tells me, again, higher terminal rate, and a higher terminal rate means a steeper curve, because the only way you're going to be able to arrest the long end going higher is by providing leverage players with positive carry. And we don't have positive carry. We need to have the repo rate well below the rate at which you buy 10 years and 30 years. And we are nowhere near that. And if the terminal rate is, 3.75 to 4%, how are you going to arrest long bonds anywhere but 4.75, 4.80, maybe even 5%? You give people at least 100, 150 basis points of positive carry, and then they will buy the bonds. So what I'm really saying, and this is a chart of a 1 month bill against the 30-year bond, and we are now at zero. What I'm saying is that we need to go down here. We need to go to around 160 basis points, maybe down here to 120 basis points. We need to be down here. We need to have a positive yield curve throughout, and this is where 1 month against the 30-year is going. And the terminal rate, I don't think, is going to be much higher than 3.75 to 4%. Certainly not if it's a Trump with a divided Congress. So you could almost say that the more Republican the thing is, the higher the terminal rate, and the more Democratic the thing is, the lower the terminal rate. But in any case, I don't think it's going to be, a question of much more than 25 or 50 basis points. So you're saying 350, 4%, 350, 4%. So it's not going to change in the long term where this needs to be, and it needs to be here. It needs to be at least 120 basis points of positive carry between the 1 month and the 30-year for this kind of budget deficit to be financed. Which brings me to the one I said I wouldn't mention again, but I'm going to mention it one last time. To me, this is the safest position you can have, because it expresses the positiveness of the yield curve, the fact that the terminal rate will be higher, and the fact that all hope that the Fed is just going to keep on cutting forever disappears. And, this is U against Z25. I think we've broken. I think we are going up here, and we're going to be at 0 or at 2 basis points positive quite quickly, within a couple of weeks, probably within a month. We are trading in positive territory. If what I've been saying is correct and we need a positive yield curve, this spread has to go positive. So what I'm saying, why am I saying it's the safest? Because what are you going to lose if you're wrong? Are you going to lose 4, 5, 6 basis points? Yes, okay, but you are going to have positive spread of something like 12, 15 basis points if I'm right. So your risk reward is excellent, and you know that you really can lose very, very little, 5, 6 basis points. So you can afford to put on hundreds and thousands of these spreads, because you more or less know your maximum loss, and you can work it out that way, how many you can afford to put on. I have a lot on, and I plan on putting on more and more and more. Europe is basically only going to trade on a spread to the US for next week. And it really depends on the election outcome. The more Republican it is, the more we start breaking upwards. And we are talking about here twos. I really would not be surprised to see this level exceeded. And tens. 203 is going to be massive, or 204, 205. But I think the more Republican it is, the more up it goes. And it really wouldn't surprise me if we saw even 220. It's going to be a volatile week. The only way this spread comes in is if there is violent risk-off in equities, and that's the blue wave scenario. Otherwise, I think it's a continuation of the up moves, whether you're looking in tens or twos or fives. So let's have a look at fives, and I think even they are going to trade around the 218 area. To me, the market has decided that yields in the US have to stabilize with a positive curve at a higher terminal rate than the one that the Fed would like. And the last one for the Brits, this is the gilt against the US. And as you can see, after the budget, zero move really. Just volatility up and down, but net nothing. I don't think that the budget was, ridiculous. It's not expansionary. And really what this chart is saying is that we are going to remain quite locked in the relationship between gilts and the US. So whatever I said for the US applies to gilts. And yes, this spread slowly, is remaining and yes, this spread is remaining between 60 and 0 and will remain in this area for quite some time. But I just don't see that gilts are going to be the one next week which moves more than the US. I think at the end of the week, that spread is either likely to remain very neutral or have come down a little bit, unless it's a blue wave, which is as I keep on saying, the only outcome which the market is really not priced for. Well, you really know what I'm going to say here. The more Republican, the more up we go, because the more the differentials will go. And therefore, I think if it's in the unlikely event, and I do think it's unlikely that it's a red wave, we certainly trade up here, 106.25, and that, funnily enough, is the top of the Bollinger Bands on the weeklies. So we go straight up there, and spike it a little bit to stop everyone out, and then probably come back a little bit and then go again. But the more Republican this is, the more tariffs are going to be introduced, or the likelihood is higher, the more we spike upwards. That's all there is to say. If it's a blue wave, which nobody has priced in, watch out for the dollar, because it's going to go down hard, and it's probably going to go all the way down to par or even lower to stop everyone out. There's going to be selling galore. I just wanted to show you the yen as well, because if I was the Ministry of Finance in Japan, I know when I would intervene, and that is on a big spike, which basically takes out this kind of level, 157.5 and higher. And, as we approach 158, 159 on a spike, I would intervene. And that would be my red line saying to the market, no, you will not trade 160. So if you see a spike in the yen, and I'm not talking about the Dixie, and I'm not talking about Euro USD, I'm talking about just exclusively the yen, don't forget to buy a few sneaky puts on, on dollar yen, i.e. calls on the Japanese yen, because I think that they would intervene, and they would intervene heavy and take it all the way back down to this kind of level, 154, which is not very far away from where we opened, and that's when you get out again. But I do think that this would be the ideal time for the Ministry of Finance in Japan to intervene. And if I do see anything, 158 and a half, something like that, I'm going to buy some 155, 150 put spreads and just leave it at that. And I think it's going to be very quick. I think they're going to, I think the volatility will have collapsed, so those puts will be very, very cheap. But B, I think that is when the Ministry of Finance intervenes. Now, is gold a buy the rumor, sell the fact? I don't know, but it's still doing nothing wrong. So it's not really making new lows. If it starts trading below 2650, yes, then you are getting a bit worried. But I just can't see that gold is the sell. Okay, yes, it'll be hurt by yields and real yields going higher. But I think we're all beginning to doubt the narrative that the Fed has a 2% target written in stone. And while that is unlikely to change very much with administrations, it's what's propping up gold. So the dips, to me, are still buys. I just can't see that we are going to see a situation in which gold is trading below 2560, and whatever happens next week, whoever's enthroned, it's just an unlikely scenario. And really the one in a blue wave that's not priced in, and I keep on saying it, it's probably my favorite asset. The problem with DBC is that it has a hell of a lot of oil, over 50%. And I just don't know where it can go in the short term. It can go anywhere in the short term. It can get really massacred if it's a red wave, but then bounce hard. So I'm not really looking to sell it even on a red wave, which I think personally it's unlikely. I think that I would like to buy a dip simply because, as I've told you, I think the market is concluding that the Fed is not committed to getting inflation absolutely to 2%, but they're going to come up with the usual fudge. 2% average over the long term, and we've had inflation below 2% for a decade, so let's have it above 2% for a decade. Well, it doesn't quite work like that with bond markets. The bond market will definitely punish that. So I think it's likely that this market on dips, it bounces. And the only way that I can see the spread to gold, and this is gold to DBC, coming back down towards the 200 moving average, as opposed to just continuously bouncing higher, is if we have a blue wave, because that should be definitely bullish for oil, and should be bullish for all the other metals as well. That you're not talking about immediate tariffs. So DBC, to me, the more blue it is, the more it should be going higher, because A, the Fed will be easier, B, the bonds are in risk off, so they're supported for a while. So I think that DBC should be a decent hedge at these levels if it's a blue wave. Well, since I have absolutely no idea what the outcome of the election is going to be, and no one no, nor does anyone else. All I can do is have levels. I think there is very little chance that this level now holds, this 56.70 on the clean chart. So I would have thought that the first announcement of something the market doesn't like dips to at least 55.68 and potentially dips down to here and fills some gaps down to 54.46. Who the hell knows, okay? Because that's 300 points. That's kind of limit, isn't it? So you are really looking for a lot of volatility on the announcement, but an immediate repricing lower of volatility once we hit a level. I think the level is likely to be a lot higher, i.e. these levels don't hold on a Trump victory. I think you get a spike, but I would sell that spike if it's a divided Congress, as I showed you in that presentation. I would definitely sell that spike because I think it's going to come back, and then you buy calls, and it should be really cheap to buy calls then, because volatility, as I said, will have repriced. And then you look for a continuation of a Santa rally. If it's a blue wave, as I said, that's the only scenario in which I don't buy the dip. I just walk away. I sell my equities and I walk away. I don't know how far it can go down. I mean, how long is a piece of string? It can go down a hell of a long way. It can go even down here, and fill this gap, 50, 60. I'm not saying on Wednesday. I'm saying over the course of 2-3 weeks. I really would not be a buyer on a blue wave. I don't care. I'm walking away. I'm just looking for short levels for alpha, and my beta portfolio gets decimated. I just sell just about everything I have in US equities. So that is all I can say about it. If the market gets disappointed for whatever reason on a Kamala Harris win, but it's a divided Congress, you've got to buy calls. And the market dips, you've really got to buy calls around this 55.70 area, maybe slightly lower. I just don't see why the market wouldn't like it. If volatility has really plunged to around the 13-14%, buy 1 month, buy 2 month calls. Why not? The one that you should definitely consider buying and just tucking away, as it were, in the case of a red sweep, which is to me unlikely, but who the hell knows, is IYT and the transports. It's basically coiling and has coiled for 2 years solid, if not even longer. And this is basically as high as it ever closed, 16,850. This spike is something that you could easily get in the transports, and it could easily go a lot higher. But here's IYT, which is the ETF, and this is really the highest it's ever closed, 71. And if we start taking out 71, I think there's a lot of momentum here. There's 3 years worth of, this, whatever you call it. And it could easily do this much again on top of here. So you're talking about 20% higher. It could really go a long way. That's the one that I will be buying and just tucking away a few if it's a red sweep. I very much doubt it will be, but that's the one that makes the most sense in that case. Why do I think that volatility is likely to actually collapse on the election? Well, because A, the event has happened, but B, because the whole time while the market was going higher, volatility was not going lower. It was very, very supported. And then it basically spiked. So I think a lot of options have been bought by people who needed to hedge the election. And I think this election is actually probably better hedged by real money than any other election in history. And that is why, unless it's a real surprise, something like a red wave or a blue wave, I think volatility is going to get smacked, and smacked all the way down to the 200-day moving average real quick, i.e. around the 16-15 area. And that is going to provide us with opportunities to buy calls or buy puts. I think that that is almost, the thing that's guaranteed to happen, unless it's an extreme outcome. And probably extreme outcomes are not that likely. So I think that volatility really does get smacked after the first initial spike up or spike down on the election results. The only scenario where I can't see volatility getting spanked is if it's a contested election or some other, something that is also unlikely to happen, which is people start fighting, in the streets about what the result was. You can't predict that, but that's the only way that volatility stays high or goes up. Good luck to all of us, and that's just about all I can say. I don't think these levels are going to hold. I think the yield curve still steepens almost whatever the outcome, apart from in the short term, and I will upload naturally the presentation as well with all the outcomes. The only way it doesn't steepen is a blue wave because of the risk off, because people abandon equities and the money's got to go somewhere. Otherwise, to me, it's still a steepener. You saw the relationship between 2s and 5s and 5s and 30s. You saw the butterfly 2, 5s, 10s. And that tells me that it's a steepener and that things will continue to steepen over time. Naturally, there will be ups and downs, but the steepener is the trend. And having positive carry for long-term bonds, to me, is a given. It's a must. It's what the Fed has to achieve in order to get the deficit away. Because if it's a split Congress in any way, will the budget deficit be addressed? No, it's unlikely to be addressed. So the most likely outcomes, and it really doesn't matter who is president, is increasing budget deficits and therefore a Fed which has to consider the bond vigilantes and has to consider term premium and has to consider real rates. And the only way to do that is to give them positive carry. So that is my overarching macro theme, positive carry, and that requires a steeper curve over time. That's all I've got for you. Naturally, we will be tweeting every 5 minutes over the course of the election on Tuesday evening into Wednesday. Let's hope that we get a clear result, because then what happens is that volatility collapses. And if volatility collapses, that gives us great opportunities in options. Thank you very much indeed, and I'll be with you every step of the way on Tuesday and Wednesday.